How to prepare for a stock market crash, and Warren Buffett's strategy. Before we dive into the Buffett strategy, it is important to understand how the stock market ends up crashing. So, in this video, I'll break down the main reasons why the stock market crashes, and then I will show you Warren Buffett's strategy to prepare for a stock market crash, and invest in the stock market, divided by 4 parts. Now let's dive in. Stock market crashes often occur in environments characterized by prolonged bull markets with rising stock prices and high economic optimism, elevated price-to-earnings ratios above historical norms, and widespread use of margin debt and leverage among investors. Although a crash lacks a precise numerical definition, it generally refers to a rapid decline of over 10% in a stock market index within just a few days. Crashes are marked by panic selling and abrupt, steep price drops, distinguishing them from bear markets, which are prolonged periods of declining prices that can last months or years. Crashes can occur during bear markets, but they don't always coincide. For example, Black Monday in 1987 did not trigger a bear market, and the collapse of Japan's asset price bubble unfolded gradually without distinct crashes. Stock market crashes are relatively rare events. There's a lot to cover, so I'll keep this intro brief, but stay tuned because, in a moment, I will also give you a priceless, golden egg, 11 criteria Warren Buffett uses to buy a stock. Also, if you find this content valuable, please hit the like button. It costs nothing but helps our channel tremendously. Here are the 5 stock market crash characteristics. 1. A stock market crash is characterized by a rapid and steep decline in stock prices, often following a period of market uptrend. 2. Stock market crashes are typically identifiable only in hindsight, with notable examples including the crashes of 1929 and 2008. 3. Conducting thorough research and diversifying your investment portfolio can help increase its resilience during a market crash. 4. Market crashes can present opportunities to buy stocks at lower prices or to execute a Roth IRA conversion. 5. Consulting with a financial advisor can also help you prepare for potential market downturns. Now let's go to Buffett's strategy to prepare for a stock market crash, presented to you in 4 parts. Let's dive in. The first part of Buffett's strategy is to know what you own. Warren Buffett never buys a stock without fully understanding the business behind it. Once, I asked a businessman what kind of business could make me a lot of money. And he replied, the one you deeply understand. This principle also applies to investing in stocks, as buying shares makes you a part of the business. The only difference is that you are an investor. In fact, some major investors even have legal rights to influence the companies they invest in. When aiming to make money from any business, the first rule is to understand 3 key areas: the company itself, the industry it operates in, and the cycles related to its products or services. For instance, Buffett avoids investing in tech stocks because he doesn't fully understand their business models or industries. During the dot-com boom, he steered clear of tech companies, feeling they lacked the long-term performance history he required. Even during the 2009 bear market, despite having billions in cash, Buffett refrained from investing because he couldn't find any stocks that met all his criteria. An interesting fact is that Berkshire Hathaway is now a major American multinational holding company based in Omaha, Nebraska, but was originally founded in 1839 as a textile manufacturer and began its transformation into a conglomerate in 1965 under the leadership of Buffett and Vice Chairman Charlie Munger. The second part of Warren Buffett's strategy is the criteria he uses to decide what stocks to buy. Berkshire Hathaway depends on a comprehensive research and analysis team that meticulously reviews vast amounts of data to inform its investment decisions. Although the specific techniques used are not fully disclosed, the following 11 requirements are commonly seen in Warren Buffett's strategy's investment approach. So here is your priceless golden egg, 11 criteria Warren Buffett uses to buy a stock. 1. The company should operate within a strong and growing economy or industry. 2. It must possess a consumer monopoly or have a brand that commands strong loyalty. 3. It should not be vulnerable to competition from entities with substantial resources. 4. Its earnings must be consistently rising, with stable and strong profit margins. 5. The company needs to have a low debt-to-equity ratio or a high earnings-to-debt ratio. 6. It should demonstrate high and consistent returns on invested capital. 7. The company must have a track record of retaining earnings for growth. 8. It should avoid high maintenance costs, significant capital expenditures, or substantial investment cash flows. 9. The company must have a history of reinvesting earnings into valuable business opportunities. 10. Its management needs to have a proven track record of generating profits from these investments. 11. The company should be able to adjust prices in response to inflation. For example, Buffett's selective contrarian style, in a stock market crash, includes making some large investments in blue-chip stocks when their stock price drop, and could be at low levels for any specific strategy. The third part of Buffett's strategy is to know when to buy a stock. Buffett often makes concentrated purchases during market downturns, such as during a stock market crash. Market downturns can present opportunities to buy stocks at discounted prices, so it's essential to be financially prepared and willing to invest when prices drop. You might be ready to buy the dip if you have an emergency fund, your retirement savings are on track, and you have cash set aside for daily expenses. Keeping a list of stocks you're interested in allows you to act quickly when prices fall. Watching your portfolio decline can be uncomfortable, but making strategic decisions for your future self can help ease that discomfort. Financial advisors frequently highlight that market downturns can be ideal buying opportunities. Thorough stock research should include a written record of each investment's strengths, weaknesses, and purpose, along with the criteria that would justify selling. This research serves as an investing roadmap, a tangible reminder of what makes a stock worth holding. During a stock market crash, this document can prevent you from selling a solid long-term investment just because of short-term volatility. Conversely, it also offers clear reasons to sell a stock when necessary. The fourth part of Warren Buffett's strategy is when not to sell a stock. So, does Warren Buffett sell a stock during a stock market crash? It's crucial to remember that selling investments during a downturn locks in your losses. For instance, during the February 2020 market crash, a $1,000 investment in an ETF tracking the S&P 500 would have dropped by over 30%. If you had sold at that low point, you would have cemented your losses. However, by holding on, you would have seen your investment recover by August of that same year. Re-entering the market later, under more stable conditions, often means paying higher prices and missing out on the rebound gains. Warren Buffett, for example, never sold any stocks during a market crash because his focus is on the long term. He relies on thorough fundamental analysis before making any purchase. It's natural to feel uneasy when the market declines and your portfolio's value drops. However, if you're investing for the long term, sometimes the best strategy is to stay the course. Ideally, you should have assessed your risk tolerance before investing, understanding how much volatility you can handle in exchange for potential returns. Long-term investing requires enduring market fluctuations while remaining invested for the eventual recovery, which historically follows downturns. If you didn't evaluate your risk tolerance or thoroughly research your stocks, you might be tempted to sell at the worst time, locking in losses that could have turned into substantial future gains. Your reactions during market turbulence will reflect the depth of your research into the stocks you hold. Remember, recent market activity can influence your judgment, so a thorough analysis of the sector and the company can help you avoid mistakes during a stock market crash. The bottom line: Buffett's approach to handling a stock market crash is to view it as an opportunity to acquire high-quality companies at attractive prices. He has crafted an investment model that has consistently benefited him and Berkshire Hathaway shareholders over the long term. Buffett's strategy is both long-term and selective, involving a rigorous set of criteria before making an investment decision. Additionally, he leverages a substantial cash reserve, or war chest, which allows him to purchase large quantities of shares when opportunities arise. This ready availability of capital positions him to seize chances for substantial returns and buy stocks during future market downturns, provided they meet his investment criteria. Thanks for watching, good luck and good profit. Edward Cash Trader. Please read the disclaimer in the description below. You can support the channel by subscribing and turning on notifications. Let's grow the channel together.